In this video, we're going to talk about the Nasdaq Composite Index, Digital World Acquisition, Sndl Growers, and Polestar. We're going to cover the price actions of each and every one of those stocks, and then address my opinion about each and every single one of them. The first one we will talk about is Nasdaq Composite Index, trading under the ticker symbol QQQ. So during the most recent trading session, the stock initially rose from $338 to around $344 before retracing back to around $335 and closing with some recoveries at around $341. In other words, there hasn't been a lot of movements on Tuesday, which is refreshing considering that the price trend over the past 5 days has been clearly bearish. The stock went from a peak of $357 to the current level at around $338. And needless to say, that correction did not finish yet, and we should wait and see whether it can find some support during the next couple of weeks. From a long-term perspective, the stock has been trending up for the best part of the past 5 years, with periodic dips that can probably be explained by both profit-taking and sector-wide volatilities. But at the moment, the upward momentum has been going longer than any previous bull runs. And I would say that a significant market correction, a real one, is long overdue. This is why I wouldn't necessarily be worried about what's going on right now with QQQ, other than the fact that it may be helping us to find a good entry point. Now, let's move on to Digital World Acquisition Corp, trading under the ticker symbol DWAC. Over the past few days, the stock has been seeing some obvious upward momentum, and this has been the case for the past few weeks as well, as the market was expecting the launch of the company's products. There have been attempts of corrections, and so far, the upward trend line between $80 and $83 has been holding the stock pretty well. The $90 level can potentially become a new support line as we go forward, and the rest of the price actions depend on the market's opinion about the application, and more specifically, whether there will still be online following surrounding the stock now that the anticipated event has occurred. From a longer-term perspective, although we may not have enough data to give us a comprehensive view on the entire situation, so far the stock has been meeting with favorable echoes from the market, especially from the retail traders who own more than 90% of the company. This is a clear sign that a company's volatility is expected to be high and remain to be high in the short and the medium terms. That we should be careful regarding whether we want to hold the stock long term as well. For now, I think that the shareholders are going to enjoy for some time the bull run on the stock, before asking ourselves what's next once the reality sets in. The third company we will look at is Sndl Growers, trading under the ticker symbol Sndl. Over the past few days, the stock price of Sndl Growers has been continuously declining, from 65 cents to just below 55 cents. With that being said, there have been renewed hopes coming from the recent attempts to recover some of its losses in early February of this year. The recent price actions are triggered by the fact that there are tensions in the real world, and that this tension is also reflected in the decisions taken in the financial market. Market participants in general are now more reluctant in taking risks and buying speculative assets. The stock has been on the softer side of things for many years now, and this tendency will probably keep going on for some time still. From a long-term perspective, the price action of Sndl Growers has been ranging within the limits of the penny stocks, and that has been going on since at least the past 2 years, with very occasional peaks before going back to where things were. Nevertheless, it's worth mentioning that the floor of Sndl Growers is around 38 cents, and this is what makes the current price trends interesting. And having a position in the current circumstances may, and this may surprise you, may be too early for the market participants, because 15 cents may not seem much, but in this case we have to reason in pennies. And the fourth company that we will be talking about is Polestar, trading under the ticker symbol Ggpi. Over the past few days, the stock price of Polestar initially tried to maintain itself above $12, but over the past few days, the stock price corrected lower once again, and currently it is trading around $11.50. The stock price of Polestar has been slowly recovering over the past 30 days, and overall it maintained a bullish trend. From a longer time frame, and once again, we may not have enough time for a longer time frame, but with the maximum time frame that we have, I think that the stock price was able to maintain a structure of the bullish trend, because the floor has been maintained around $10 so far, even though the peaks have been trading lower over time, every time the stock tries to peak. I think that the volatility of the stock will be reducing over the next couple of weeks before going up once again. Another thing to note here is that the price of Polestar has resisted a massively bearish sequence of events in the industry, and this may be something positive for investors looking to hold the stock in the long term. Going forward, there should be more optimism in Polestar and should encourage us to hold the stock longer than just a few weeks. Obviously, keep in mind that the supply chain issues have been affecting the stock for some time, and this may come back around the reporting periods. We should be prepared about this possibility and its effects on our position. Now, let's move on to my opinion and recommendation for each of those stocks. My overall opinion on Nasdaq Composite is bullish, and it is simply a question of identifying the right entry point for the capital, since the correction may not yet be finished at this point. And because so much money has been buying in the index over the past 2 years, that a deeper market correction is probably beneficial. My recommendation is to wait for the best moment to enter in the index, which is either when the index reaches around $300 or when the price begins to show solid support levels below which it'll refuse to go, and that can last for at least 1 week or longer. I would recommend a maximum exposure of 15 to 20% of your portfolio and split them in batches of 20% to leave room for later buys. Now, let's talk about Digital World acquisition. My recommendation is to buy it now, because the current stock momentum is clearly bullish, and it'll remain so for at least a short to medium term. Nevertheless, I think that we have to remember to control the risk exposure around this position, because remember, regardless of how rosy the situation is now, bulls will run out of steam someday, and that there may be some questions to be asked when institutional investors don't seem to be that interested in adding DWAC on their portfolios. So I would recommend an exposure of 3 to 5% of your portfolio now, and to buy in at around 40% of your allocation, or up. A profit target between 15 to 20% seems reasonable right now, and then the profit should be used for the long-term holding, should you choose to do so. Regarding Sndl growers, my opinion is to watch out the stock closely and to be prepared to enter the stock if the price gets near the 40 cents level. With that being said, given the weak level of participation by institutional investors at the current stage, the stock should be considered as a trade opportunity rather than an investment for the time being. The maximum exposure in the stock should be around 1% of the portfolio. The profit target should be within 20 to 30% of the cost basis. And now, let's move on to my opinion on Polestar. It is overall bullish, even though the trend is relatively soft. The entry point is near a region where the stock price has corrected sufficiently low already, and that should be a sign for investors to start going in. I would recommend a maximum exposure between 1 to 3% of your portfolio and enter the stock with 25 to 40% of the allocation right now. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon, because the financial sector would see its profit margins reduced, and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.